I recognise the audience here is a mixture of people who know quite a lot about the space and some who know very little, so this inevitably will be a bit of a compromise. Let's talk about, in a way, what's changed in the world. So this is the old model of funding. So I think important thing here to understand in brief is that companies go through different stages in their lives, and the sort of advisors that they have, the sort of support they need, and the interest of investors will vary by stage. So I'll briefly say, stage one of a company is when you've come up with a good idea and it's generally funded by family and friends. It's inevitably private. Carries on, you get to about 10, 25 million pounds of equity value, and outside investors start to get interested. You might have EIS, for example. And in the old days, you got to 25 million, you might even start to think about listing on the stock market, on the alternative investment market. And then by the time you're up to $1 billion or so, you might be thinking about the main market. And there are different sorts of investors at every stage. There's different sorts of risks at every stage. That's the old model. This is the new model. There it is. And most important, what's happened? So what's happened is that companies come to the stock market much later in their lives, and that's resulted in a shrinkage in a number of public companies, not just in London, but around the world. The number of AIM companies has fallen by about 50% since the peak. If you go back to 1995, the average IPO on AIM was for a market value of 21 million. By 2020, that was 127 million pounds. Why has that happened? That's quite an important change. Well, lots of reasons. First of all, you've seen a growth in private equity funds. So they've been very successful in raising money from investors, mainly institutional. Secondly, some people may remember there was a blow up in an open-ended fund run by Neil Woodford. One result of that was that the regulators, compliance officers, fund managers are much more focused now on the liquidity of their holdings. We've seen a loss of assets by small cap fund managers, so there are fewer investors at the smaller end of the market, and the merger of wealth managers has also meant they want bigger companies to invest in. So there are fewer investors typically around that sort of small, medium-sized company space in the public domain, and they've been replaced by private equity. There is a even newer initiative that's come along called PICE. Can't remember what it stands for, but it's for private companies with intermittent trading venues. They're very much at the early stages of that, and there are 3 providers in that space: the London Stock Exchange, Asset Match, and JP Jenkins. On the screen, is it? The traditional bank has disappeared. So, the world of Captain Mannering being able to make a decision in his local branch and lend money has gone, went a long time ago. And the big banks aren't really interested in lending to small companies any longer, which is my introduction to Ivan when he comes up to speak. So the first thing for investors, if you're looking at this as an investor, is to think, what sort of company are we looking at? What size company? And different investors will have an appetite for different levels of risk. The second thing is to think about, what sort of company is it? Is this an early stage? Am I taking a bet on something working, a new drug or whatever? Is it a proven growth formula, maybe ex-growth now, but I've got Greg's in there, where once you've got the formula right, the opportunity is just roll it out across the whole of the country. Is it a roll-up or a buy and build? So I put in there CVS, which is a big vet. So the advantage for a big player in the veterinary market, you take a lot of costs out by buying local practices generally owned by originally the vets. What sort of investment? What sort of investment is it in that? Then the next thing to talk about is, what are the opportunities for investors in this space? So I've already said there's less opportunity in the quoted market to participate in smaller companies, and it may be the case that there are complete sectors that are now not on the market you can't get access to any longer, and they can be perfectly good sectors. One response to that is to go and buy a PE funds. Private equity used to be simply the remit of big sovereign wealth funds, family offices, institutional investors. There are ways now, and there have been for a few years, retail investors to participate through the investment company structure. There are a number of PE funds that way. The next way to look at it is EIS. So the UK has been very successful in the tax-enhanced space through things like enterprise investment schemes, SEIS, which is for even smaller companies, CTs, that sort of thing. And they give you substantial tax advantages to compensate you for the risk. Huge sums of money have been raised in the UK in this space. In 2023, which I think was the last year we got the data for, £1.5 billion was raised for EIS companies, and there were 3,780 of them. And since the scheme started, £34 billion has been raised for EIS. So it has been very, very successful. UK is pretty good at early stage. And there's actually political agreement about this because, in fact, Rachel Reeves wrote a piece about just how great EIS was. Well, she was Chancellor, admittedly. So they're good at that. Where we lose out is when we get to the bigger companies, they tend increasingly to get sucked out by US investors who tend to value things like life sciences and tech higher than we do in the UK. So I think as an investor, when you look at the world, you've got to think about, in the small company world, you've got to think about, what size is this company? What sort of risk am I taking? What type of company am I buying? And then you think about, how can I get exposure through PE, through EIS? And then the final thing I wanted to say is what managers and founders struggle with. I think as an investor, it's interesting to know this. Now, I see this day in, day out. And I think what founders and managers struggle with is they don't understand what I've just described about there are different stages for a company and there are different investors they appeal to. They understand their business very well and their market and their competitors, but they can't talk investor. They don't know the way an investor's going to look at something. If you're looking at a life science company with an early stage drug, what you're going to do is to say, well, okay, how big is the market for this potential drug? Many competitors are there. How far are you from getting approval and getting it to the market? And how much is it going to cost to get there? How much money have you got left on the balance sheet? What's the cash burn? Are you going to need to do another fundraising? That's a completely different story to, I get companies come in and say, oh, we pay out a big dividend yield, therefore we must be attractive to dividend investors. Box one ticked, but a serious dividend investor is going to say, let's have a look at the history of the dividend. How consistent has it been? Let's have a look at how volatile the business is. How can I be sure that you're going to pay? What's the free cash flow cover of the dividend? Completely different set of questions. Companies, founders, managers don't understand that. And in a sense, why should they? Because they don't talk to investors day in, day out. And then the other thing I find companies say to me is, we don't know how to value our business. And we're really frightened we're going to get taken advantage of by some smart kid from a PE fund who does know how to value our business and is going to pay us far less than it's really worth. So those are things that I think founders and managers struggle with. There's a number of things I've talked about for investors to participate. I think there's some really good things you can take part in the small company space, but it's an ever evolving